tail risk and gap protection. Let's talk about protection. Let's talk about risk management. Let's talk about defensive overlays. And again, we're gonna, like we've done in a prior video lesson, we're gonna look at multiple scenarios. We're gonna look at multiple what ifs and different styles on how to protect a position or a portfolio. And some will be applicable to how you trade, and some will be just out of curiosity for you to know. So let's begin. First thing that we need to define is what tail risk means. And again, this, if you are an expert in statistics or data science, this is obviously not something that is strange to you. But if you are not in that field, you may not be clear on the concept of tail risk. And basically, what it means is that if you were to take the behavior of the market, any stock, in the S&P 500 index, you were to take any market and you were to model it, you were to look at the daily move, for example, and you were to observe through time the variations of that daily move, you would realize that there are certain things that are much more likely going to happen, and there are certain things that are absolutely not likely going to happen. And then you would probably conclude, if you were to use basic statistical applications or theories that are designed to understanding data but also to simplify, you would apply, for example, a normal distribution, and you would end up with a graph of this sort, which is a bell curve, which you may have seen before. And basically, all these different possibilities that you would observe on market data would be located somewhere here in the middle, that we call a one standard deviation. Certain things that happen in the market, more violent moves, would be happening here or here, which are less typical, still possible. That would be 2 standard deviations. And then anything above 2 standard deviations and 3 standard deviations, 4 standard deviations, would be seen as the tail of this particular distribution curve. And it would be seen as something very unlikely, very unlikely. The thing about the markets is that while certain things are very unlikely, and indeed they are, sometimes they are so exaggerated that one of those unlikely situations could destroy a portfolio where you've been profitable for years, and then there is 1 week where everything is gone. So this is what we call tail risk, when something unexpected takes place in the area in this graph where it's already pointing at what's unexpected. So you got something unexpected on top of unexpected, which means very rare, but definitely extremely violent and extremely relevant. And the idea here would be how to protect against such events. Okay, this is what we mean by tail risk or tail risk overlays. So first option that many traders would consider when protecting a portfolio or a stock position would be to use stop loss orders. And the beauty of the stop loss orders is that they are free. So that's a great beginning. They don't cost money, and therefore it's a great way to get started. So that's fantastic. But on the other hand, the stop loss does not provide a complete protection. And the reason why is because you depend on liquidity available in the marketplace, and you also depend on trading hours. So liquidity, first of all, means that when you are willing to sell a stock that you own because maybe it's moving against you, then there is someone ready to buy it from you so you can sell it to them. Maybe there is no one to buy from you, there is no liquidity, or maybe there is someone ready to buy from you, but maybe they only want to buy from you 5% below price. And if that was to be the case and you get filled on the chart, you would see a gap. Okay, so they bought from you, but there is no trading since the current price until you got filled 5% lower. You would have a 5% gap. On top of that, markets like the US equity markets, even though things are changing, most of the trading activity is happening and is concentrated during a window of time which is 6.5 hours, typically from 9:30 a.m. in New York all the way to 4 p.m. in New York. That's 6.5 hours, and this is where normally entering and exiting, as long as you trade liquid stocks, it's fairly doable. It's not too problematic. Having said that, it's not the case with other stocks that are not liquid, and definitely not the case if you try to exit a position when maybe it's 5 p.m. in the US, in New York. Maybe there is no liquidity and you get this 5% gap I was talking about. So the stop loss orders, while they would take you out of a position for a specific loss, and they are free, they don't really protect you the way we are defining protection in this conversation. If you were an intraday trader and you are in and out during the day, and you are trading during liquid times, and you don't trade after the market is closed and all of those things, so yeah, stop loss could be and probably is the right way on how to protect your position. But if your approach to risk management and your definition of exit is more serious than that, then a put protection is definitely the way to go. The downside of buying a long put is that you have to pay for it. But the beauty is that no matter what happens to the stock, no matter if there is liquidity or not, no matter if there is a gap or not, no matter if that stock went bankrupt and therefore the shares are trading at $0 per share, no matter what, you have a predefined exit which is guaranteed, which is why you pay, so you can have that guarantee. So defense is critical, and the beauty of buying those long puts, even though the downside is that we have to pay for them, is this asymmetric payoff. So if you buy a put to protect a stock position or a portfolio, and the portfolio keeps moving higher, for sure, you will lose what you paid for the put. That's lost. It's a fixed amount of money, we call it premium, and it will be lost. But if the market was to go down, the more it goes, the more the put will protect you, giving you that guaranteed exit. So you have this asymmetric payoff, which is extremely powerful. There are other ways on how to protect stock positions as well as a portfolio overall. In prior video lessons, we talked about buying a put, which I was like rephrasing now. We talked about collars. We talked about cover call strategies or cash secure puts. We talked about long straddles, long strangles. Each have a different application, a different ideal market environment or timing to be utilized to provide maximum efficiency, and the reasons behind that would also depend on your trading plan and approach to trading. But basically, generically, when it comes to protection level, the long put gives you absolute downside protection. Below that strike, you are fully protected. The collar is also giving you protection because the collar is made of a put, so that put is giving you that absolute downside protection, and it's financed because you sell a call and get paid and take that premium to then buy the put. So that may imply that the put is located a bit lower than what you would want to make it free. Of course, you can always do a collar for a debit, and then the put will be higher and you will get more protection. But typically, when traders use collars, they do it for the reason of having either very cheap or slight credit or a free type of protection. So normally that may bring the put slightly lower, but again, below that lower strike, you got full protection. Another way to think about defense, and that's a delicate word to use here, is the cover call or the cash secure put. That more than a defense, what's really giving you a buffer that allows you to be wrong by a certain amount, because you receive a credit, and that credit, that's the buffer. Okay, if you get paid 2, then you can afford the stock to move by 2 against you, and you're still okay. If you sell a cash secure put and you get paid 2, when now the stock is put to you, and the moment it's put to you, your real net entry price is the strike price minus the premium, so you could afford the stock to go by 2 against you, and you're still okay. So you have a buffer. That's what it really is. And then with the long straddles or long strangles, we are just betting on volatility expansion, really. We are not betting on a direction. It's very difficult to evaluate and measure how much it will protect you, because the protection depends on the magnitude of the move against the portfolio. The more it moves, the more it protects. But again, it really depends. Now, what's the cost of the strategies? Where for the long put is very simple. It's a debit and it's high. Especially if you want high protection, you need to pay high debit. For the collar, good news is that it's typically either very cheap or 0, or maybe even has more credit. For the cover calls is net credit. That's the great benefit, even though there is a sacrifice, as we'll see in a moment. And then for the straddle and the strangle, there is also a very high debit. You buy a call and a put, so it's double the debit, so it's indeed high. Everything got pros and cons in life, so what's the sacrifice? With the put, to be honest, none. If it goes down, you get totally protected. In a way, the sacrifice is the fact that the debit is a high debit, it's a high cost. What about the collar? The sacrifice is that if it goes up and up, your upside is capped to the strike price of the call you sold. For the cover call or the cash secured put, it's similar. It's the opportunity cost because, again, a cover call is made of a call that you sell above price, so you would be taken out if the market rallies. Or with the cash secured put, you want the shares put to you, but if the market rallies, the shares were never put to you, you made some money on the premium collected, but that's obviously less juicy than if the market came to your strike and now you own the shares and now they move up. So there is an opportunity cost that could be a part of this game. With the long straddle or the long strangle, so we are talking about no sacrifice like the long put, but of course the sacrifice, one more time, is the fact that we need to pay a hefty level of premium to be in those trades. So when would you want to use a long put? If you're planning on a black swan event, a flash crash, that would be very efficient. When would you use a collar? If you're expecting the market to go up, but like slowly, okay? Or maybe you have some level of concern for the market to stop going up and maybe go down. So then a collar would be a great application. If you expect the markets to go sideways and you want to structure your entry or your exit, in this case you can use a cover call or a cash secured put. Again, it's all about the premium you receive is offsetting the fact that the market is not doing much. That's the thing. And then for the long straddle and long strangle, it's a binary thing. You just need a massive move, and that typically comes from Fed decisions, earnings reports, things of that sort. The downside, again, is that it's going to be very expensive. The classical downside protection that is being used is the protective put. It's simple. You buy that one put, is 1 unit for each 100 shares of stock that you own, and that's it. Okay? It's acting as a strict floor for the portfolio or the stock, and if the asset drops, no matter how much it drops all the way to zero, the portfolio value is locked at the put strike price. You are totally protected. The trade-off, the premium paid, that acts as a drag. And again, one thing is that you are an independent trader. A different thing is that maybe you manage other people's money. It's even more than drag. In this case, buying a put, I would call it drag with capital letters, because often money managers or asset managers, they try to beat the market. They try to compare their performance against other asset managers. And the last thing they want to see is that the market is going up and they are making less money than everyone else because they keep buying puts for a just-in-case situation. Now, the fact is that year, that quarter, when the market really collapses, they look nice. They look with very nice performance, very nice protection. So that's fantastic. But all these other months, when the S&P was going up, they don't look good. Okay, that drag effect of buying puts is often not welcome by most practitioners. While it's a valid protection, and therefore it very often be used for temporary situations where there is perceived risk for into next week, into next month, and the protection is purchased and acquired for that particular event or perceived situation. Now, the collars, again, remove the problem of cost. So no drag any longer. You buy the stock, you buy the put, because you sold a call that got you premium that allow you to pay for the put. That's the collar. Stock plus put minus call. So that's fantastic. Now if the stock goes higher, you profit. If the stock goes lower, you have protection. But again, if the stock goes higher, the call strike will call your shares away from you if the market keeps rallying. And while you are not suffering performance to the upside because you keep buying puts and you keep losing premium by buying puts, you are limiting your upside potential by selling a call above price that will call your shares out. Okay, so again, it's less demanding, less eroding, but there is also a component of capping profits. Of course, in the video lesson on cover calls as well as on colors, prior video lessons that you may have watched. We did talk about rolling up, rolling out. We did talk about management strategies to try to alleviate the problem, but the problem is indeed there. Like everything in life, again, every action that we take will have a positive side and a downside as well. So cover call and cash secure puts, again, it's all about the buffer. So the buffer that the cover call provides in case the market goes against you. So let's say you are selling an option, you get paid $3. So now your buffer allows you for the stock to go down by $3 and you're still okay. With the cash secure put, you don't own the asset yet, but the phenomenon is the same. So if you sell the 95 put, as we can see on the right, and you get paid $2, if the stock is put to you, your real entry cost is 93, which is 95 minus 2, because the premium collected is kept. So in other words, you have created a buffer of $2. So these strategies are fantastic to either create a little bit of income while you wait either to buy, in the case of the put, or you wait to sell, in the case of the cover call. And if you are assigned, then you get that discount that you may want to think about it as a buffer. And that's very nice, okay? Having said that, again, it's a limited income strategy, because the most you can make when you sell an option is what you collected from the option. So if you sell a cover call, you get paid 3. The most you will make until the expiration date is 3 from the option. If you sell a put and you collect 2, the most you will make from that put is 2. The other element for tail risk protection that could be employed is the long straddles or long strangles. Again, here we are betting on a massive move. That's what we are betting on. So I'm thinking about if in front of Liberation Day, for example, a trader would have put together a long straddle, the size of the profits would have been fabulous, incredible. It would be such a powerful thing. Now, of course, you would have had to do that before the Liberation Day. So not only you did it before the move started, but you also did it before everybody started to expect that things were going to start getting complicated around the world. So in other words, there was no fear in the market yet. Options were very cheap, and you were able to build your straddle with cheap options and then catch the move. That is fantastic. If not, as we discussed in prior video lessons, it's problematic. So let's go over what if scenarios now that we refreshed a little bit. What is a long put? What is a collar? What is a cover call? What is a straddle, a strangle? Let's talk about battle plan A, right? So let's say you own a stock and you want to survive the earnings void. Okay, why am I calling it void? Because earnings typically generate lack of liquidity prior to earnings, to then lots of trading after the earnings report is out. But also because not only you have limited liquidity while everybody's waiting for the report, but you also have even more limited liquidity because almost every earnings report is taking place either before the market opens in the US, in New York, or after the market closes in US. Most of them. And therefore, when the number comes out, there is either the markets are either closed and you cannot trade, or you could trade the pre-market or post-market session, which are very healthy from a liquidity point of view. So in other words, you may find yourself in a stock position that you were very happy with, and next thing, a bad earnings report, or maybe a good earnings report, and everybody knew it already, it was priced in, creates a 20% gap down, and then you're in a very problematic situation. So again, buying a put before that would be a great way on how to protect your stock prior to earnings. But as we discussed in a prior video lesson, make sure you don't do it the day before earnings, because then the options are going to be overpriced. Battle plan B. So let's say you want to defend the slow grind. The slow grind is a problem because that means that your stocks are not making much money to the upside. If you have a fast market moving up, impulsive, moving up fast, it's very easy to make money, and you make a lot during the year. And then even if you spend the whole year buying puts because you made a lot of money with the stocks, that's all good. But if the market is grinding slowly to the upside, the problem is that the speed of movement is generating maybe a 4% return after a whole year of trading. And if you kept buying puts every single month, the drag is maximum. So that could be very problematic. So again, the typical application here would be to do collars, where in this example, as you can see, we are selling the 215 call, get some premium, 5, and then take those $5 and buy the 190 put, which also costs $5 in this example. So you have a defense in place, but the cost is 0. And because the market is just grinding slowly, so odds are that you will not reach 215, so you just keep rolling that collar month after month or quarter after quarter, depending on the expiration days that you use, but you have this protection element the whole year without costing you money, without creating a drag. Another possibility would be to include rollovers into what you do. Let's say you are in a put position that is a defensive put position, and now you only got 10 days left to expiration. So step 2 could be to sell to close it, and then step 3, buy a new put using 60 days to expiration now. Again, this is fantastic and efficient and guaranteed protection, but again, it costs money. So the timing of the rollovers should be as intelligent as we can. A trader should be monitoring the levels of implied volatility, and maybe you don't roll over 10 days to expiration just because it's 10 days to expiration. You just wait for the implied volatility to come down. You probably remember we discussed in prior video lessons that volatility goes up and down and it tends to revert back to the mean. So you will want it to be below the mean price, and then you would now have an opportunity to enter your puts at a cheaper price, and then keep doing it at the most ideal price as possible if buying puts is what you wanted to do. Plan for the void, not the dip. Okay, when we are planning for tail risk protection, you are not planning for, oh, the market went down for 2.5% this week, I want to protect against that. That's going to be very expensive protection. Time decay is going to kill you and is not going to work very efficiently if you are trying to protect a very small move. Now, if what you want to do is to position yourself to defend something really problematic in your account, such as a 20% overnight gap, now we are talking about something much more doable and lower cost, right? Because now you can use an out of the money option, you can use other strategies, collars, all sorts of things that will bring you in protection for cases where it's worth it to be protected, but the insurance cost is going to be much less. Respect the drag. Okay, respect the drag. Absolute protection causes portfolio drag, and buying long puts all year long causes portfolio drag. So if you overinsure, you guarantee underperformance. It's a normal thing to hedge portfolios partially. It's a normal thing to not to hedge too close to price and allow for a little bit of a, let's call it a breathing space, and have certain strike selections which are a bit further away from the current price to make our protections to be a bit cheaper. Of course, it's going to be less protection, but it's going to be less drag. So it's all about balancing it out, and of course it would depend on the investor mindset. It would depend on the investor style and what is the priority. Are you more focused on protecting capital? Are you more aggressive on collecting alpha? What are you trying to do? And finally, make sure you do it on time, right? So you cannot buy fire insurance when the house is already burning. You need to get your protection in place before anything already started happening. Because if you try to buy protection when everybody else is already buying protection, then things become quite complicated, very pricey, and then the efficiency is not going to be there.